Hello, Patrick Vernon here, author of Venture Capital Strategy, How to Think Like a Venture Capitalist. Today, we are looking at how VCs do their job, specifically how they help portfolio companies grow. And we're going to take three perspectives. One is a sort of macro portfolio-wide perspective. And if we look across the portfolio of a venture capital fund, it looks less like traditional investors and more like a major record label in terms of our hits-driven thesis. You know, a record label will have a roster of artists. They've signed record deals for all these folks. You might think of a record deal as a Series A investment. But it's after the record is cut that the real work goes into making a rock star out of a rock band. We got to get them on the radio. We got to get them out there in front of a bunch of people. We got to get them on TV and in the motion pictures. Got to get their displays and all the retail outlets. It is no accident that you start to see an artist everywhere. That is the big machine of a record label pushing hard, and they cannot afford to do this for every single artist on their roster. Similarly, venture capital funds, and we've got a roster, we call it our portfolio, and we can help. We might not quite be as actively engaged, but we do help our startups grow. And we might have one that's super crushing it and they're just going great. Maybe they're raising a Series B and we need to help them put together a syndicate. Or we've got another one that's just our pet project. We love it so much, but it's having a hard time finding product market fit. What do we do this morning? Which one are we going to spend our time on? These are really tough decisions, and early stage VCs that I work with say it's their favorite part of the job, like how to roll up your sleeves and help these companies. Like, what do you do day to day with helping these? Well, what do we do to help? In an earlier chapter, we looked at the fact that we are active investors. We likely will get a board seat if we want one. And being on the board does not mean that we are going to run the company, but we do hire and fire the people that do run the company. When we make an investment, we generally are going to want a proportion of the board seats that's pretty close to the proportion of ownership that we have. So, and we want a small board and an odd number because we don't want ties. We want a board that's nimble and can make quick decisions. On the board are people that have a stake in the outcome, like early investors and co-founders. It can be tricky because if we want a small board, we might need to remove some people from the board, and we don't want to hurt feelings because we want everybody motivated and working towards success for the startup. And then we want people on the board that add value, like ourselves. It is our job to bring value. And this is one of the things we'll pitch when we try to get into the deal, when we invest in the startup. These are the things we were going to do for you. Now let's look at some of those things. What are they? First and foremost, it is a long, strange trip. For most entrepreneurs, it's probably the first time they've done it, or maybe they've done it once before. But as VCs, we've seen this over and over again. We know how this record plays, and we can help that process. And that's really important expertise that we bring to the table. And we also bring our vast networks, right? We saw this earlier in deal sourcing. We saw it with fundraising. And here we are trying to grow our portfolio companies, and we're tapping into our vast network once again. Super important, just like record labels do. It's the record labels network that allows them to get you into all these doors. A band cannot do these things on their own. Another thing we can do as a firm, and this is a relatively new thing that started happening about a decade ago, is we can hire staff for our firm to help the portfolio companies. Andreessen Horowitz really was a trailblazer here, and some other companies as well. But VC firms didn't used to look like this. I mean, that's a lot of faces right there. And we're only to the letter M on their website. And by the way, here are the partners, Mark and Ben, kind of just stuck in there. VC firms used to look more like Kleiner Perkins still looks, which is a relatively small investment team and some support staff. This is probably twice as many as they had 5-6 years ago, because most of these people are on staff now to help portfolio companies grow. And the main thing they need is hiring talent and PR. But of course, the main competency that VCs, the main thing we do is supply funding. We are anticipating future rounds. So we are bringing to the table of a Series A round. One of the things we bring to the table is future rounds. We're going to help with those. We will invest ourselves and help build syndicates. We're going to have to fit this into our 10-year life cycle of the fund, right? This is a pattern in our fund that's going to repeat itself. And it means we're really, really busy at any given point. We've got a number of rounds happening, or companies in distress, or companies about to exit. It's just this graphic, and this graphic is only maybe 8 or 10 companies. Like, if we're taking board seats on all these startups, we've got to be very careful with how we spend our time. I want to run through a little glossary here to make sure we are on the same page about some of the words you hear regarding follow-on rounds. So one is milestones. And the main thing to note here is that the milestone should not be a footnote in between the rounds. It really is the purpose of the rounds. A milestone is anything that will decrease the risk and thus increase the valuation. Super important. It's a to be discussed again in a later chapter, what those milestones look like for different types of companies. Secondly is the reserve capital, and this is the money that our firm will be reserving as dry powder to invest in future rounds. And we've seen this graphic before in a previous chapter. We are baseline reserving 2 or 3x. We don't know if there are going to be 1, 2, 3, 4 other future rounds. We don't know that it'll be 4 or 6 million we put in. But if we're putting 4 million in the Series A, we have made a mental calculation that we've got another 10 or 12, or maybe just 8 for future rounds, whatever they may be. That is the baseline strategy. Now it could be different. It's possible we would do a one and done round, but that's pretty rare. It's an exception to the rule, if you will. And here's the baseline rule for a Series A. We're going to reserve 2 to 3x of dry powder for follow-on rounds to maintain pro rata. Well, what's pro rata? That is referring to maintaining our percent ownership from Series A all the way to exit. Whatever we start with at Series A, after our deal, we're going to try to hold that into the end. And that is important because we will get diluted, as everybody does, when future rounds come along. And I just want to take a moment to do that math to show you how that can look, because it becomes a big deal, can become a big deal after 2 or 3 rounds are thrown in there. So let's just do the math real quick here. Founders, of course, are going to get diluted when we come in the A round. And if we took 33%, let's say a 2-on-4 deal, as an example, then the founders will have 67%. Let's bring in a B round. By the way, we're going to ignore option pools for this moment. Let's look at the B round, where the B round investors are getting 20%. So this might be a 10-on-40, could be an 8-on-32. How do we calculate our A round going down here? There's only 80% left for the previous shareholders, and we have 33% of that. So we multiply that out here. Same thing happens in the C round. This 25%, that could be, I don't know, 25 on a 75. Could be 10 on 30. That would be a less good scenario. And once again, we do the same math. Our 26% is diluted by 25%, so we multiply it by 75, and we get down to 19%. By the way, at any time, you can hit the space bar to chew on these concepts. I'm going to fly through them in the interest of time. Note that we have gone from 33% down to 19% as Series A investors, and that is very painful to us because we are in the unicorn hunting business. We're not expecting to have very many home runs in our portfolio. So when we have one, we want to grab that unicorn by the tail and ride it for all it is worth. If this company exits for $250 million, for example, and that's not a unicorn, it's still could be a very good exit, we would be losing $35 million having lost those 14 points of dilution. And if it were a unicorn, oh man, we are not happy campers. We lost $140 million of gains. Those are proceeds we might have had we not been diluted. So if you're hunting unicorns, dilution is the enemy. The good news is we plan to participate in future rounds, and we plan to mitigate that dilution. We're going to walk through another dilution example and show you how we mitigate it. So let's do a 4-on-6 4-on-6 Series A. That gives us a post of 10, followed by a 10-on-20 Series B. That gives us a post of 30. Series B investors in this case, of course, are going to get 33% of the resulting equity. That means Series A is diluted by 33%. So hit the space bar if you want to do this math yourself. If we are diluted by 33%, we take our pre-existing 40% and multiply it by 67, and we are now down to 27%. So we've been diluted from 40 to 27. Now let's add the Series C. This is a 25% dilution. That means we're going to go down. Our Series A goes down from 27% down to 20%. So wow, in this scenario, we have gone from 40 to 20%. We are not happy campers. The good news is, using our baseline strategy, reserving 2 to 3x for future rounds, we are going to be able, I hope, to mitigate this risk. So take one look here. We've got this 4 million for the B round, but it's a 10 million B round. So we're not going to take the whole round. Same thing with a C round. We are not going to take the whole round. We're going to bring in syndicate partners to fill out those rounds. And in so doing, we will help mitigate our dilution, and we'll still have enough capital to get to exit. Hit the space bar if you want to chew on this by yourself. I'm going to walk you through one piece of it. Notice down in this corner, we took all of the 4-on-6. So we have 40% coming out of the A. As the A round investors, we went into the B. We decided we wanted to take 4 of 10. That's going to be a post of 30. So we own 4/30. That's 13%. So this is 13% to us. It's a different class of shares, by the way. Those will have B series rights that might be different than our A series rights. And then the C round comes in. It's a $20 million round. We're going to take 6 of that. So we will own 6/80ths. That's 7.5%. If you just look at the parts we own as the Series A investors who participated in the B and the C, we're up to 37.5%. And we've done a pretty good job of mitigating our dilution that otherwise would have gone down to 20%. So our baseline strategy here worked pretty well. We could tweak it and be right at 40% and we'd be fine. But the baseline strategy kind of hangs us in there. So do not forget this, and always keep in mind that it's a baseline strategy that is made to be broken. And there are circumstances where you would be breaking that rule. Let me talk quickly about what happens with up and down rounds, because they have significant implications for dilution. We have only been talking about up rounds because we're projecting the future and we are optimistic. But we should know that down rounds will have a serious impact. In this case, our A round of 4 on 6 gives us a post of 10, and our B round was negotiated with a $20 million pre. So that means we've had an up round from 10 to 20. That's 2x, right? So our $4 million worth of shares here is now worth $8 million. We should be happy, right? We're not happy that we got diluted though. It is an up round and has doubled in valuation. Now, the thing about valuation with illiquid assets, kind of like a house. The moment you negotiate it and the deal happens, you know what it's worth. But the next moment you do not, because a tornado could come through, or the toilet could explode, or the house down the street could sell for $1 million. And all of these things will affect the price of the house, but it's a conceptual price until the next person buys it. So until we do another round for a startup, and until that round is negotiated and consummated, we actually don't know what things are worth. If things go well, it should go up. And if things go poorly, it should go down. Back to this first example where we've got the 10 on 20 Series B, that's an up round. Well, let's make it a down round. Instead of a 10 on 20, let's do a 10 on 5. Holy cow, 10 on 5, the post is 15. The new investors get 10/15. They get 66%. That is draconian dilution. We're losing 2/3 of our equity. We started with 40%, we're down to 13%. This is heinous. There are rights on the term sheet that help us in this scenario, anti-dilution rights, but it's still a very bad situation for everybody because the founders, those poor folks, look, they're down to 20%, and our anti-dilution rights aren't going to help them. Thankfully, option pools can help fix a little bit of that, and we'll talk about that later. Flat round is not quite as bad, but it's still pretty darn ugly. The lesson here is just that flat and down rounds are really ugly and tough things to deal with. But as we're looking at Series A, we're always projecting a future of up rounds. We're reserving that 2 to 3x baseline strategy on a way to a successful exit. The last thing to think about is the outside lead investors that we may bring in to price the round, because as Series A investors, we are insiders. We have a vested interest in these shares going for as high a price as possible, but we also want to buy some of these. So we want those to be the lowest price possible. To get around this conflict, it helps to bring in outside investors to price the deal, to let the market decide what it's worth. And lead investors can be defined in a number of different ways, but the main thing is we're bringing somebody new in to objectively put a price on this. If you like what you're seeing here regarding VC job growth, please check out my book at vcraiser.com, where you can see some more excerpts. And for now, Patrick Vernon signing off.